Hello and welcome back to the channel. My name is Peter, and today we are going to focus on the S&P 500. We've had a massive rally over the past few trading sessions. The S&P 500 is really starting to cover a lot of ground very quickly. So what is going to be happening next? How long is this move going to last? And is it going to lead to a sharp correction very similar to the previous big moves that we saw throughout 2020? Those are the questions that we're going to be answering in this video. So without further ado, let's get right into it. So I just want to start off by quickly talking about the general technical picture that we have on the chart right now. We had that beautiful bull flag pattern that we talked about. We identified that pattern in one of our previous videos. We talked about it with our members on the site. It was a classic leg up, consolidation, breakout, and resumption, and that's called a bull flag. When you see this type of small consolidation, especially off a long-term level of resistance, you have to see this as bullish consolidation action. And remember what this level is. This is a very important level. It corresponds to that big bull market price channel that we've been looking at on the S&P 500. This is the main technical picture that traders who are trading the S&P 500 should be looking at. So we knew there was a non-negligible probability that we would break to the upside because of the fiscal environment that we're currently in. A lot of stimulus, a lot of monetary easing, and we had that bullish structure. So that was a good warning signal that we were going to start another leg higher. Now, of course, this is not a trade that we wanted to take. Even if the price action is very bullish and you get a bull flag pattern like this, you're still just under major resistance. You do not want to be going long just under such a major price channel resistance. We're going to be looking for long opportunities a little bit later once we get an objective opportunity at these levels. But now let's take a look at that shorter term chart that we're looking at right now. In fact, we're going to jump to a 4-hour chart because I do have something to show you right here. We printed a huge overbought RSI reading right here on the 5th of April. And since then, we've been on a grind upwards in terms of the price with the RSI starting to make lower highs. That is called divergence between the price and the RSI, and it can lead to a correction, especially when you're on an overbought RSI reading. It means not only the trend is going too far, but it's also overextended. We can take a look at the last time we had that type of development right here on this move up in September, leading to that significant top in September. We had the price climb and the RSI start to come down, and that led up to a significant top. Now, that doesn't mean we're going to get a correction right now. It means that the risk to reward is less favorable to the upside. It means that it's a very bad trade to be taking long positions right now after this move up and with this type of divergence. By the way, if you're so far enjoying this video, make sure to hit the like button to help our videos out. We're trying to increase the amount of content that we put out on YouTube. So if you're enjoying these videos so far, make sure to let us know by hitting the like button as hard as you can. Right here, that was a blow off top. We can take a look at the price from the bottom of that move to the top. That was in 14 days, a 7% move up. What are we seeing right now from this bottom to where we are now? That's in 17 days, a 7% move up. And we can also take a look at that blow off top in June that we had and measure the price action from that bottom to that top. That was an 8% move in 10 days. So similar type of moves. We're clearly in some kind of a blow off top move, but there's two big differences. First of all, this is less of an impulsive move. This is 17 days, which is a longer period than both of these moves, which were the same in magnitude. But also both of these moves right here came after already an overextended uptrend, right? These were big moves up in the markets that led up to a blow off top move. What did we see throughout February and March was a sideways grind. So we're emerging out of this sideways grind. So it doesn't necessarily mean we're going to see this type of correction unless we continue heading higher. If this uptrend continues up past 4,200 points, and we see this type of move, that could lead to a significant drop back down to test this level of support. Now I want to show you two specific levels on this chart right here. First of all, I'm going to show you guys this minor downtrend line that we're looking at right now, and that goes from the body of these candles, capturing this reaction right here and capturing these lows right here. So we're still above that trend. We haven't broken yet, so we could still see some type of a bounce, continue our way higher. But if we do break that trend line right here, aggressive short sellers can enter short trades back down to this level of support. Again, it's a risky trade considering how bullish the price action is right now, but that could be a quick 2% profit short trade. Now, the next thing that we're looking at on the chart right now is also this line of support that we were looking at throughout that entire uptrend right here, capturing these highs all the way through that uptrend, and we have not hit that resistance level just yet. So the markets are overextended, they've gone too far, but we're not at resistance, so we're not getting that selling pressure just yet. Right now in the extreme short term, we don't have strong convictions. These types of strong market moves, especially when you get a breakout through resistance, these can lead to big blow off tops and actually often break through resistance briefly before snapping back down and correcting. So the technical picture is clear, right? The markets want to go up. They've broken past resistance. They've broken through a long-term price channel. So the technical structure is very clear. Now, all we need is an objective opportunity. And that's not going to come with this kind of overextended reading. It's going to come after a correction back down to support. And that's what we're waiting for, whether that comes now or whether that comes after another leg higher, and then we come back to support. Now, something else I do want to talk about in this video is the gamma exposure. Gamma exposure is not something that we use all the time for trades, but it is something that we do take into consideration when we're expecting a drop in the markets, which is something that we are expecting after such a strong move up. You can see the gamma exposure has gone very high. And what the gamma exposure tells you is the sensitivity of the call and put options that are currently in the market. So if the gamma exposure is extremely high, it means call options are extremely sensitive to price action. So if you have the slightest breakdown in the market, you're going to get a quick snapback because of those call options that have gone too sensitive to the market price action. So seeing this type of move up in the gamma exposure definitely increases the risk of seeing a move down in stocks once you get that breakdown, once you eventually get that breakdown of that price channel. That was something that we had right here back in October. We had a big rise in the gamma exposure that led to a significant drop in the market. We can go back a little bit further. There are more examples right here. That was another one leading up to that significant top in 2018. But it's not a perfect indicator, right? Look at this spike, huge spike in the gamma exposure, but that did not lead to a significant correction. In fact, we continued on higher with little to no correction in the coming days. So definitely something to take into consideration, but you should not base your trades solely on the gamma exposure. Now, this kind of overview of the market is something that we do often on the site. We posted an article yesterday on the S&P 500 blow off top, talking about the different levels to watch. So if you're interested in finding out more about our analysis, whether that's on the markets or cryptocurrencies, precious metals, emerging markets, and our investment strategy on those assets, make sure to go and check out our website at gameoftrades.net. Now, that's about all I wanted to cover in this episode. If you enjoyed, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading, and see you next time. Now listen up, if you're already investing in cryptocurrencies, why aren't you investing in tax-free crypto? ITrustCapital is the only provider that allows you to invest in crypto assets within your retirement account. They allow you to not only buy Bitcoin, buy Ethereum, and others, they even have Chainlink coming soon. It's designed for beginners and experts alike. They give you 24/7 trading access and even have built-in institutional grade secure storage. You don't need to worry about creating private keys. If you open an ITrustCapital Roth IRA, it allows you to buy Bitcoin now And when the asset grows over the next few years, you keep all the profits for yourself with no taxes. If you want to learn more, head to ITrustCapital.com and you can request your free insider's guide now. This will teach you all about crypto retirement accounts and how you can invest tax-free.